This is InvestTalk. Independent thinking, shared success.
Hey guys, this is Darren in Charlotte. Appreciate the show and everything you guys do. Got a question for you about Zoom. Currently at $68. Wondered what you thought a good entry point is. If it's good enough, or if you think it should get a little bit lower before I grab a position in it. I appreciate it. Thanks so much. Bye.
So the ticker is ZM, and the name is Zoom Communications. It's a technology company that provides communication services through voice calls, through video, webinars, conference calls, primarily to businesses. Now, during the pandemic, as you can imagine, after I just described the businesses I did, it did really well. You can see in this relative strength, relative to the S&P 500, it was trading below $100 a share. Pandemic happens, it rockets up to about $5.60 a share at one point, and then slowly starts to trickle down, and really has been pretty flat, at least from a relative valuation perspective. Relative performance perspective, that is, over the past couple years, right? It underperformed in 2023, underperformed in 2024, underperformed in 2025, really every year over the past 5 years with the exception of 2020, when it returned 395%. And so with that in mind, we have to ask ourselves, well, why is that the case, right? A lot of technologies trade at high multiples. This guy's trading at 12.5 times forward-looking earnings. It's trading at 2.2 times book value. It doesn't have much debt. Its balance sheet looks pretty okay to me. It's got about 64 million with an M dollars of debt on a $22.4 billion market cap. But look at that revenue. It's really just growing very, very slowly. Again, explosive out of 2020, then starts to taper off. Now, the margins are solid, right? They're a little over the place, but with the exception of 2023, they're heading back in the right direction, projected to have 35% net margin this coming year. Now, in the past couple of days, it's done about as poorly as the rest of the market, down 7.87% over the past 5 days. Down a bit year to date, though still underperforming the S&P 500, though in line with the sector overall. And so my issue with Zoom, even though I actually love Zoom, the product, I'm using Zoom, the product right now, is that there's a lot of competitors. And one of their biggest competitors is Microsoft through Teams. And although I don't like Teams, it's easy. It's integrated in most business operations. And Microsoft and Google have spent a lot of money trying to attack that market share and that market that Zoom clearly showed was possible. And so it's kind of difficult to beat in the long run a company whose operating system a lot of people use. And so because of that, and because of a lot of other reasons, but mostly that, I think that Zoom is a great product. I'm not sure how I feel about the stock, so for now I'm going to have to pass. Thanks for the call. Let's go to John from St. Louis, who has a question about market timing. How can I help you?
Hi, Lou. First off, I just wanted to say I appreciate everything you and Justin do. I love the show. I get so much out of it.
Thank you.
I was calling because, well, I'm a government employee, and I have a TSP account, and we have a few funds that we're limited to. The one follows S&P, one follows like the extended market, another follows international fund, and then one that follows a bond, and one that follows like treasury bills. And so about a month ago, I know it's not advisable. I work for the government though, and I was seeing all the layoffs happening, and I know about tariffs and what was coming up. I sent it and I put everything in cash about a month ago, and it worked out for me as of now. And so what I'm wondering now is, I was thinking along the lines of Buffett. I once heard him say he would advise, if he was to advise anybody to put money into anything, he'd just say do 90% S&P 500 and 10% bonds. And so I was kind of planning on going that route once I decide to re-enter. I'm wondering if now would be the right time to pull the trigger on that, given everything that's happened, and seeing as how I've just fortunately decided to get out and I'm sitting in cash now.
Yeah, well, first, congratulations. And secondarily, important to know is how old are you?
I am 35.
Okay, you're 35. So you have a very, very long time horizon. And so, if you were to invest fully in a target date fund, which essentially does a glide path towards retirement, which slowly transitions into bonds as you get towards retirement, it would probably put you at a 90-10 or an 80-20 allocation right now. So 90 S&P 500, 10 bonds, perfectly reasonable, especially given kind of the limited fund options that you have. And so what I would say is, just as an example, right, we manage 401ks, we manage TSPs, we manage things for our clients. We started to elevate cash levels a little bit towards the beginning of the year for them. Nothing too crazy, 20 to 30% in some at most. Started to move a little bit more international as well. And so the reason why is because you have times, and this certainly was one of them, where you have elevated downside risk relative to upside potential. And you want to give yourself that flexibility. And that's something that you did, maybe more than is advisable, but it worked out. And so we're not going to look at the past and think about what we should have done. We're going to look at where we are. And so what I would say is if you're looking for a 90-10 allocation, equities and fixed income, there is no way to predict a bottom, right? I think there is still a lot of downside risk right now, primarily because the uncertainty is the point, right? I think even if there's a resolution towards this instance of tariffs, the problem is there's always going to be a hanging hammer and a scary tariff button that could be pressed at any time until the power is taken not away by Congress, but back by Congress, right? It is the power of Congress to enact tariffs, right? And it was given to the executive. And so because of that, this is, I think, more than ever, an important time to DCA back in. And so what I would do if I was you is I would start to make slow purchases. I think there's going to be a lot of volatility this week. I think that's just to be expected. April 9th could give us more tariff announcements. Who knows what's going to happen after this latest threat on China. But when volatility starts to go down a little bit, when the VIX starts to remove a little bit closer to normalcy, right? We saw a spike, I think, up towards maybe even high 50s, low 60s at some point today. Typically a sign of capitulation. I don't buy it. It's not always a perfect metric of that. But when you see the VIX start to lower, you see volatility start to lower a little bit, you start to see maybe some direction in the market at all whatsoever. I would start to DCA in. Right? So maybe you start to put 10% of that cash to work at first, and then you wait a little bit. You see what's going on in terms of volatility. It's sustainably lower. Then you start to put maybe 20% if you feel a little bit more comfortable. And so I think in this situation, when you are essentially 100% cash, dollar cost averaging in is the exact thing you should do. And you shouldn't try and pick the bottom here. Now, you said again that you went to cash a long time ago. So the likelihood that you end up in a worse position is very low as well, right? Because you probably sold pretty high up there too. So, but yeah, core of the message, a lot of uncertainty out there. I think volatility is here to stay for at least a little bit. And DCAing is probably now more important than it ever has been. Thanks for the call.
Thanks, Luke.
Thank you. Let's try another fresh question from the comment section of our InvestTalk YouTube channel. This question is about Accenture. It says, please advise on Accenture. Currently, I do not own the stock. Enjoy listening to your show as much as I can on 1220 AM radio. I just subscribed to your YouTube. Well, thank you. So let's take a look at Accenture. Accenture PLC. It's a global professional services company. It's a consulting business. They have a lot of government contracts. They have a lot of private contracts. They have, like I said, some public contracts, and they're operating all over the place, right? 45% from the United States, 34% from Europe and Asia, Ireland, about 1% here. And so it is a globally diversified financial services firm, consulting services firm. In terms of their business divisions, about 30% towards products, 18% financial services, tends to be like risk-oriented things, regulatory things, health and public services, as well as a big part of their business. And so a lot of people don't know the history of this company, Accenture. It actually used to be called Arthur Andersen back in the day. But anyway, so it is a global consulting firm. It has very spread out revenues. But the reason why it's down 20% in the past 3 months, 19% year to date, isn't because of tariffs. It's because of DOGE and the implementation of cost-cutting initiatives that have terminated several contracts that the U.S. government had with Accenture that it made up about 8% of its revenue. And so in a time when businesses may be cutting back, in a time when Certainly the U.S. government is cutting back on its consulting contracts, and you have issues of heightened trade tensions. Is it a good time to buy into a business and government consulting firm? And so I would think, looking towards its balance sheet, which looks pretty healthy, right? It's buying back shares. Its dividend yield is pretty solid. That in a different time, this would be an attractive name. Its revenues growing, right, at a slower basis than it did over the past 6 years, but still growing. And its profit margins are overall still profitable and pretty darn stable. But I think the overwhelming macro conditions are such that getting into names like Accenture right now, probably not a good call. Thanks for the comment. Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates.
Sid from North Carolina, thanks for being patient. You got a question about Dell?
Yes, Luke. Good evening. Thank you for taking my call. I do have a small position in my rollover IRA account. I picked up around 110. And right now I am roughly 30% down due to this recent downfall. So it's around 75, 76. Fundamentally, I still think that this is a good company, but not sure this is a good price or what would be the future like due to this all volatility. So I appreciate if you can give me your inputs and what would be the next buying point or good entry point. Thank you so much, Luke.
Yeah, thanks for calling. I always like it when you call, Sid. But Dell, ticker DELL, is a very large computer manufacturer. It's a technology company. 50-50 revenue between the United States and international markets. $51 billion market cap. About $25 billion in debt. So a decent amount of debt from the company. But, at the same time, their interest coverage ratio is sitting at about 5 times. So really nothing too insane there in terms of leverage. Now, the company struggled over the past year. It's down 43.49% on a 52-week basis, down 34.92 year to date. It's down 17.79% in the past 5 days. And the reason why is really the tariffs, right? They are uniquely exposed to international manufacturing. Now, this isn't a Dell product, but I recently saw an old article from Forbes saying that if the iPhone was 100% manufactured in the United States, one iPhone would cost between $30,000 and $100,000. And the reason why is because we just can't produce things in the United States that require that type of small tool manufacturing. And so that inherently is going to raise the cost of electronics a lot. Couple that with the fact that hardware companies tend to be cyclical just because of the nature of the hardware software push-pull in technology. It doesn't stand to, it doesn't bode well for at least the short to medium term for Dell. Now, I agree with you that it does make good products. I use a Dell computer. I've been using Dell work computers for a decade, but at a certain point, you have to look at where you are in terms of the business cycle, where you are in terms of the macro environment. And should a lot of these tariffs stand, which frankly, it seems like the president just likes tariffs. A company like Dell could really suffer. And so I don't see a buy point in the near future unless there's a resolution here. And I think that you're likely to see, again, some volatility, maybe because there has been such downward pressure on this name year to date. You may see some relief rallies. But frankly, I think that you have better opportunities elsewhere. And that's coming from somebody who does, in fact, like their products. You just have to look at the environment as well when you're looking at allocating your portfolio. Thanks for the call. Let's keep things moving and get back to the InvestTalk voice bank.
Hello, Justin and Luke. This is Paulo from Gaithersburg. I called the other day thinking that this might be a good time to buy some of the downbeat stocks, and I'm actually looking at Jacobs Solution. I have it in my portfolio. It's a bit down, of course, like everything else, but I think the company is quite good. It's an industrial company. It doesn't have much debt. It's in a good space, and I was thinking to adding to my position, and I wanted to see what you guys think about the company and if it's a good time to at least buy a few more shares to see if that's a good strategy for now, or if we should all stay more calm and not do anything right now. Looking forward to your answer and talk to you soon again. Bye-bye.
So the ticker is J and the name is Jacobs Solutions. It is a global professional services firm. It's headquartered in Texas, and they provide a broad range of technical, professional, and construction services like consulting, planning, and engineering across various industries. In terms of its revenue breakdown, most of it comes from the US, 62% of its revenue from the US, 23% from Europe, and then smaller portions from other countries. It's a $13.8 billion market cap company. Not a lot of debt, only $2.75 billion in debt. About 4.82 times interest coverage ratio. Not a lot of short interest. They buy back shares. Cash flow, stable, not really growing too crazy. Profitability, a little bit over the place over the past 4 years, but trending in the right direction. Their net margin growing from 2.9% in 2021, projected to be about 6% this year. But one thing that I don't like is over the past 8 months, their earnings have been all over the place in terms of projections. And so analysts are recalibrating, retooling what they think that is likely to look like. Now, with that being said, the relative valuation, it's pretty reasonable, 17 times forward-looking earnings, about the average of where it's been over the past 5 years, trading at just about sales. And you mentioned it is down, right? Everything's down. It's down about 5%. Well, not everything, but a lot of things are down 7.4% in the past 5 days. But from a momentum perspective, the past 1 year, it was in a pretty consistent downtrend until it, like the rest of the market, dropped off of a cliff. And so similar to other Accenture, that is, if you have managers that are going to pare back on the amount of spending, one of the easiest ways to do that, right, if you're not deploying new technology, if you're not deploying new buildings, if you're not deploying new business segments, is to not pay these hefty consulting contracts that a lot of these companies are desiring. So although it does look actually attractive to me from a relative valuation basis, the momentum is telling me to just sit on the sidelines on this one for now. I think its balance sheet is good. I think it's trending in the right direction. But the market is kind of telling you, just wait and see. Thanks for the call. Alrighty, the fun, I guess you could say fun story of the day. And that is that markets surged on Monday, right? We opened down and then they surged 7% because a tweet claimed that the president would pause tariffs for 90 days with the exclusion of China. Now, when I saw this, when I saw the market react, I thought that was funny because I had seen 5 minutes before a tweet from the president saying, essentially, we're not backing down. And I thought, well, this is really strange. Something is going on here. But the market immediately, nor near immediately, dumped back down. So what was the source of this? Well, it all started when Kevin Hassett, economic advisor to the president, went on CNBC and they asked him if the president was thinking of pausing. But he didn't hear the question. And then they repeated the question and they asked, well, did you hear the question? He said, yes. And so somebody interpreted this as him saying the president was thinking of pausing. And so this anonymous X account with a blue check that they pay $8 a month for, named Walter Bloomberg, whose name may not even be Bloomberg, who does not work for Bloomberg, posted that according to sources, the White House was going to, or the president was considering pausing tariffs for 90 days with the exception of China. Someone said, who's your source? He said, Reuters. Made it all up. Caused a $5.5 trillion swing. $5.5 trillion swing. And I'm sorry, he was on Fox News when he was saying this. He wasn't on CNBC. Social media amplified this. Real Bloomberg reporters stepped in and said, not only does this guy not work with us, we don't even know what his real name is. It's probably not Bloomberg. I actually years ago made a comment to a friend when I saw this person posting on Twitter because they just rapid fire. I saw them rapid firing out news, or rather, tweets that were supposedly news. I said, I feel like one day this is going to be a problem. And I was right. And this goes to two things, two issues. One is a fractured media environment. People don't know where to get legitimate information anymore. And so because of that, you have a swing of a dollar value that is greater than the entire size of the US market 40 years ago, right? 5.5 trillion. Just off of a tweet of somebody whose name may not even be Bloomberg. Now, the other part of that is something I alluded to earlier, right? Which is the market is hypersensitive right now. It is looking for any excuse to feel as though there's not a bad outcome here. And so the lesson I have for you is not just that a single tweet can spark billions in volatility and risk on, but is understand on one fold how difficult it has become to find facts, how difficult it has become to find out what's really going on, which means not that you can't do it, but it's your job to go and seek it. Because again, we say this at the top of a lot of shows, educating yourself is one of the most important parts about becoming a better investor. But also understand that if good news does come, the market is seeking it. If you see the market pump 3%, just like it did today, 7% actually, went from negative 3.5 to positive 3.5. Don't think that's it, the bottom was in, I got to chase it. Relax, stay calm, understand market structure, understand that being disciplined is one of the hardest things, but most important things about investing. Looks like we got another live call. Sammy from San Francisco. You got a question for us?
Yeah, hi, thanks, Luke, for taking my call. Would like to get your view on Palo Alto Networks, PANW. What do you think would be a good entry point given all the price changes that have been going on in the stock market?
Yeah, let's take a look. Palo Alto Networks, it is a cybersecurity company. They specialize in, I think, cloud security as well as firewalls. Year to date, their performance has been pretty much where the rest of the market has, right? They're underperforming the S&P 500 by about 2.3, but they're still outperforming their industry by about 20 basis points. For the past 3 months, they're down 13.14%. It's a fairly large company, I would say, $111 billion market cap with not a lot of debt, only about $1.4 billion in debt. And they do issue shares, right? They're up from 600 million back 5 years ago to 650 million. So pretty decent chunk of shares issued. But their cash flow looks pretty stellar. Their cash flow has exploded over the past 3 years. What about their profitability? Well, they lost money during the pandemic, as a lot of companies did. But then their margins started to improve dramatically. 6.4% in 2023, 32% in 2024, projected to be about 24% this year. Now, in terms of earnings, they've had a consistent ability over the past couple quarters to exceed earnings expectations. And one of their main focuses has been on thematically what has driven the markets, at least up until February, for the better part of the past year and a half. And that is integrating AI within their technology. Now it's trading at 43.6 times forward-looking earnings, which is below its average, but still I think a little bit too rich for me right here. I think it's a good company. I just think it's incredibly expensive. It's been way more expensive, but especially when there's a lot of downside risk in the market, I don't think now is the time to enter here. Thanks for the call.
Discover more valuable information at investtalk.com.
Hi, Duncan from New York. Thank you for all that you do. Quick question on stock tickers. I don't know if they're an actual stock or an ETF because I'm trying to get used to this gold information education. GDL and IAU. Saw these two on a YouTube comparison investing channel. And it just seems like IAU has a cheaper expense ratio and that it's just cheaper in price. So if I bought more of it compared to GLD, I think I'll get more out of it down the line. I just wanted to know your 2 cents and thank you very much. Bye.
Okay, so that is actually GLD and IAU is what we're looking at. I think the caller said GDL at first. But let's take a look at GLD first, and then we'll move on to IAU. GLD tracks the gold spot price, less expenses and liabilities using gold bars held in London vaults. That's pretty cool. 3-month performance is about 11.92% on a price basis, NAV at 13.62%. It is what is the structure here? It's an ETF. Okay, so it's an ETF, inherently lower cost, tax efficient. Expense ratio is about 40 basis points. Let's take a look at IAU. IAU is the iShares Gold Trust. The expense ratio is about 25 basis points, so certainly cheaper. 3-month performance on a price basis, 12.18% against that. That is a net of fees, is that price. And so, I think it comes to essentially what you are looking for here. If you want higher liquidity and a larger fund size, you probably want to look towards GLD, right? GLD's liquidity is just higher. It's a $91 billion fund. It tends to trade a little bit more. But what you're paying for that liquidity is 15 basis points in fees on an annual basis. And so if your goal is to trade gold, then maybe GLD is where you want to be. If your goal is to hold gold, well, then you're going to want to go for the more cost-effective, cheaper fund, which is IAU. They both are generally going to give the same investment return. Gross of fees, again, there's going to be a difference. Net of fees, the main difference being how much do you need that extra liquidity? Are you a long-term investor? Are you a speculating trader? Thanks for the call. Now, before we head off, let's talk a little bit about oil. Right? There has been a movement of oil prices down pretty dramatically, close to what is a pain point for oil producers. And that's because oil tariffs are not only hitting oil field supply chains, they're also likely to have knock-on effects on demand. And so naturally, the price of oil has fallen. It was below $60 a barrel at one point, but $60 a barrel is where it tends to get a little hairy. And I know this is counterintuitive because none of us likes to pay any amount of money for gas at the gas pump. And you think to yourself, okay, oil prices are falling. Gas prices may in turn fall. This is good. Why don't we like this? And that's because oil tends to be, like I said, a harbinger for demand and growth in the economy. When they fall off steeply like they have in the past week, it's because market participants are anticipating a lower demand for energy, because energy is required to create anything on this planet, and inherently lower growth. Now, when you get to a certain point, close to about $60 a barrel, when you start to dip below that, well, then it actually becomes not even profitable for a lot of these companies to produce oil. That's when you start to see capping of wells. And so when we're looking forward to say, okay, what is the effect of these tariffs going to be? The oil market is a very, very, very important place to look. And so over the next weeks, we'll see how this starts to shake out. It will certainly have wide-ranging implications across industries. Now, I hope that doing InvestTalk Market Madness, we all learned a pretty valuable lesson here. It's fun. It is a fun game that we started last year. We've been doing it this year, but the intent is really to provide a lesson. And that general lesson is, what you expect to do the best doesn't always do the best in the short term, right? Dollar General had a pretty rough most of the last 18 months, but it won this tournament because daily pricing tends to be a random walk. Daily pricing is random. The best way to invest has been and will continue to be as long-term investors. Hopefully this has taught you, while you've had fun, investing on a daily basis, which is essentially what you're doing, is a little difficult. This is InvestTalk, independent thinking, shared success. Good night.